Let's bring in Ben Breitholtz to get right to the charts. He's a data scientist at Arbor Data. Ben, pleasure to have you here on a historic day. You've been a key component of our coverage with your guys' data analytics and your tools to assess what people are saying about all kinds of stuff. So right now, what are they saying, and what can you pick up from the tea leaves you guys use about the coronavirus? Tell me where to start here.
Yeah, so what we've been doing is kind of burrowing into the most real-time alternative data that's available to us, and that has to do with the search activity of consumers and businesses. And so what we've seen is in Asia Pacific, we saw an absolute explosion in search activity for COVID-19 symptoms, consumer activity, and really healthcare responses that ultimately led to the jump in realized cases, and that you can see in this chart across China and across a lot of Asia Pacific. The only problem was that continued, and as we got cases to grow in the Eurozone and now also in the US, we saw the same explosion of unexpected search activity, in particular, again, things like shortness of breath, coughing, flu-like symptoms, and those absolutely exploded most recently in Italy just around February 20th, and then migrated throughout most of Europe, in France and so on, and now also it's occurring in the US. And we found that these statistics have been a fantastic leading indicator of economic and also financial market distress.
And right now, Brazil's moving up in this search count. Obviously, Italy did before slowing a little bit. What else is pulling up here that is moving in a way that suggests maybe there's more to come?
Yes, so Latin America is a sticking point, and they have a low degree of cases right now. I believe Mexico is showing somewhere around a dozen, and Brazil is showing somewhere around 50 to 60, which we think is way too low. So if you look at that symptom-based search trend, we're finding that those two economies, Mexico and Brazil, are seeing quite the acceleration in the degree of searches. So it's a sign of cases that are likely spreading, and also, more importantly for financial markets, fear and confusion that is taking over the consumer and their psychology and likely propensity to spend.
I see. And this is as of March 7th. Just there's a little typo there. March 7th, not May 7th. Okay, so Ben, we've got areas here that are moving upwards, which suggests there's still going to be a case count climb that is, we have to separate the spread of it from the case count. We don't, they're closely tied, but as more testing happens, especially here in the US, we know that number is going to go up. And it seems like from your research, Latin America is a place where we should expect the numbers to go up as well.
Yes, and really it's the U.S. too as a whole. So as we are able to actually test more individuals, I think we're able to test something like 16 to 20 per million per day, which is incredibly low, costing at least 1,300 a pop. But the U.S. has a series of cases and likely communities that have already gained and see this virus spreading. We have taken the same approach, search activity for COVID-19 symptoms, and applied it to the U.S. as a whole. And what we found is there's pockets that are underreported, areas like Austin and Cleveland and so on, that show much higher likely active cases on the rise. And also, again, not just to track the amount of cases, what's more important to your viewers most likely is the spread of fear and confusion and really a lack of education about what they should be doing and what's happening on the ground. And I think that's what's really percolating and really allowing the equity markets to run into some major trouble.
All right, now as a result, the question is, how much does this then lead into consumer activity? Clearly, we know by default of all the cancellations here in the US, it's going to take a major hit. Right now, you've got another way to look at search activity for consumer behavior, and this thing goes super negative. What's the comparison here? It doesn't look like anything in the past decade.
No, and that's what's scary. So, we've gone back and attempted, and I'll explain the chart in a moment, but we've attempted to find similar periods within developed economies where we've seen sudden stops in economic activity, and you really can't find them. You have to go look at failed states or failed economies, which is scary. That's not the situation we necessarily have here. But this is a condition where consumers are already showing the propensity to full stop a lot of their economic activity. So this chart is showing you the unexpected search activity, removing trend and seasonality for everything from going out to the nightclub, to a restaurant, going out to buy groceries, going out to the trampoline, indoor place, whatever it may be. Consumers are not getting in within their search windows those searches for that type of consumer activity right now. They are more or less hunkering down. We've seen all the reports of people buying up toilet paper, toothpaste, whatever it may be, but they're not currently searching for what you'd expect them to at this moment, which is I'm going to go out on the town, I'm going to book my restaurant reservation, or I'm going to fly to Florida for spring break. This is, like you said, seeing a full stop. And I think as a rolling sum of all this activity, again, it's had a very good lead time on the growth of the VIX, MOVE index, and really just volatility in general across financial markets.
Now, the other one you're looking at, again, points towards Latin America as maybe being a little bit behind here, that we should expect a bigger drop than what we've seen so far. The consumer withdrawal is the way you phrase it. The next chart we're going to pull up. How are you measuring this? And define to me that kind of consumer withdrawal. I'm imagining it's pretty close to what you were just outlining for us, but this one in specific, what are we looking at? Just the drop in terms of normal versus where we are now?
Yeah, so what we're looking at is the degree, the amount of change we've seen in this actual search activity for what consumers should be doing, which is, again, going out to eat, buying groceries, buying T-shirts, and so on. So the drop has been considerable in the majority of Europe and now in the U.S., but we've seen the laggards in Latin America, which have had the highest propensity in recent weeks to actually still continue daily activity. And you can see that with Brazil and Mexico, the dark dot, the current dot being to the right of previous, indicating that they have yet to fully realize this fear component. And I think that's something that's going to hit. It's going to be a location that is likely going to see a dramatic rise in cases and likely get the same type of fear that the U.S. has kind of all of a sudden gotten just in the past 3 or 4 days.
How do you connect this data, Ben, with the market move? Is there any way to assess the kind of vector of coronavirus spread or coronavirus concern with the vector of the market? Do we have any way to gauge in this very new risk, right? This is not GDP numbers. This is not ETF flows. This is something that we have no idea how to quantify what it means for the economy or the markets. What about the speed of the development? I imagine that might be some degree of way in terms of kind of gauging momentum, to where if one day we see the momentum in your COVID data may be slow, but the market's momentum hasn't, we look for those kind of dislocations. What do you think?
Precisely. So what we've been doing for our customers is essentially trying to figure out when we get this trough in the spread of the virus and also the consumer and business response. So if they are going to make going to stop essentially their stopping of searching for a lot of these different activities, items, services, once that momentum bottoms, we believe it's going to have a lead time on actual economic activity and then also on financial markets. So the same thing we saw with Italy, essentially seeing a rise in COVID-19 symptoms on the search side, which occurred really just prior to February 20th. That gave us a good lead time. And then we saw the same thing here in the US, where all of a sudden, all major consumer search activity just stopped in the final days of February. That was the precursor to the economic and the financial market event that we've had right now, with stocks down 10% today. So what we're waiting for is for that to trough and to begin to improve. So once the consumer feels like they can go back outside, or at least they can start to make purchases and don't feel so crimped. And again, this has a lot to do with education, and this is a lot to what the administration and governments have failed to do so far, but is to squash that fear that's really revved up in the past 4 or 5 days. So this is really a psychology thing with all so hard. That Main Street psychology needs to improve, and the first signs will be that search activity coming back. We don't see it yet. I have no idea when it will, but we'll be tracking it day by day.
All right, looking forward to following it. Ben, one other chart I want to make sure we get to real quickly is about the move in the bond market and inflation expectations now, which have fallen off a cliff, of course. I think that's at least the story. What do you guys see? Because I've heard arguments that this could be inflationary, it could be deflationary, and now the expectations priced through bonds seems that it's not only deflationary, but it could be one of the biggest economic collapses in our history. And I'm just reading from the bond market here.
Absolutely. I mean, this is the greatest debate, I think, question and topic for investors. And like the chart that you're showing right now, what's happened is break-evens, essentially inflation expectations for the next 10 years have fallen below headline CPIs by tremendous amounts, 100 to 150 basis points, which has, is really only comparable now, since this chart's not fully updated, to the financial crisis. And if you look at the options market for inflation, they are now pricing in better than 90% probability that the headline CPI in the US, which is around 2.5%, is going to fall all the way to 0% and stay there for the next 2 years.
Wow.
And looking 5 years out, they're pricing in about a 75% probability of that actuality too, which to me seems crazy. And in that we're going to have this, likely it is going to be somewhat of a short-term event, even though it feels like hysteria and the end of the world. But on the back end, once economic activity improves, what we've been able to see through a lot of our work with deglobalization has a very strong habit of maintaining inflation to, if not boosting inflation on the back end of these type of events. Now, we don't have anything exactly comparable, but on the back end, inflation likely will remain stable to higher. So inflation expectations are probably the most beat up market and maybe the most disconnected from reality due to all this economic policy uncertainty and due to really the short-term fear and liquidity issues that the bond market is undergoing.
Ben, I want to talk more about that, but we're out of time. Let's set that up for our next tick, because I think it's a crucial point. But right now, figuring out the case for Corona and the searches around it is definitely paramount. We'll keep following that with you. Ben Breitholtz joining us from the Arbor Data team.